Hi, today is Sunday the 26th, and this is the SPX Outlook for the coming week, with due consideration, of course, that the market has not reopened yet. The futures market will reopen at 6 p.m. Eastern. Needless to say that last week I was wrong. I let my judgment being clouded by personal issues, looking after my Alzheimer mom, and although I am not into personal development, stress management, and so on and so forth, like other mentors do, I could mention John Locke, who does a lot of that. I'm more of a quant, technical, rational. I allowed myself to be wrong. For those of you who have followed me on Slack on my SPX Outlook, you know that I'm way more often right than wrong. So okay, those things happen, and this time I know why. Also, here I'm showing you a chart provided by a good friend of mine who does the research for a very large hedge fund, $35 billion under management, and this is part of his research. And again, it shows what I've been saying over and over, that the bull rally is essentially a retail rally, and of course, this is a bull market with higher volatility, and the cost of hedging and makes it that sometimes institutions would like to recoup some of their losses on hedging, because the market being always bullish and hedging costs. Those red lines here are VIX expirations, third Wednesday each month. And when I received this last Sunday, the VIX September future was to expire on Tuesday night, and we had on Friday already some indication the market would go down. You know what happened later on Monday? The market fell quite sharply. So this story proved right again, and I believe until the market goes back to something akin to normalcy, we will have that kind of event, with institutions selling to recoup some of their hedging costs upon expiration. So beware that October will probably be just the same, unless of course the market goes into a sizable correction where of course institutions will make money on their hedging, and of course the retail, being a lot more fickle, will definitely lose their shirts. So now let's go back to the chart. So on Monday we had a sharp fall to about 4,300, a recovery, and as you can see here, the 43.75 support never broke. And when I saw this pattern, it was clearly a very bullish market, shooting up, testing for actually below, penetrating for the 75. And then when it goes up again, I knew it would be bullish. So this is the market as of Friday, about 44, 55, 49. And what can we expect this week? Well, this time, I don't know. This tremor is probably looking for more tremors. So it's going to be agitated for a while. The earnings will only come, the major earnings will only come end of October. But at least we have now a trading range, 4,300, 4,550. We have a trading range to work with. I would assume the market will eventually go back to 43.75. But when institutions pull back and let retail buy, the market can actually go further up again. As a matter of fact, those lines, support resistance lines, blue line being the strong support, red being the strong resistance, have moved up, and more surprisingly, more or less when the market was actually hitting a low. So yes, the market could grind up. I would say that the major test level will be 45.30. We're still quite a distance to go to get there. So I would say that the market may go into what we have been accustomed to, which is bullish congestion, until the market drops again. It's going to be probably quite violent when it comes. If we look at the daily chart, we see that this little tantrum has left the market breaking the upward channel. So it's a matter now of testing the lower boundary here, whether it can go back into it or reject it again. So this is actually a very interesting test area, 4450 to maybe 4500. I would assume the market will try and grind up in low volumes. As you can see here, there's a lot more volume on the downside than on the upside. So again, it will be maybe at the next VIX expiration or any time in between. But until institutions whistle the end of the party, the market may just keep on grinding up. So for tomorrow, here we see that the market actually stalled on 46.60.70, and I would believe it can actually grind up to 44.80 and maybe, as I said before, 4500, and eventually this pattern will reach its target. There's of course a higher target, much higher here, but I don't think it will get there anytime soon. So what we would probably see is that, as you can see, there has been tops here around 44.90, so that would be testing the rejection of the upward channel. This is not a very accurate line, it is more or less what it is. I could have actually put it right here. It doesn't make any much of a difference, except that if it's this low, yes, we are already about there. This test level returning to the previous upward channel or not, this test will probably come Monday or Tuesday. I would assume the market will conscious at first. Another thing is that on the geopolitical front, the tension is rising fast between the US and China. Last week we had the AUKUS, so some form of alliance between Australia and the UK. On Friday, the USS Ronald Reagan started sailing through the South China Sea. There will be some form of retaliation from China. Tension is rising, and who knows where the first domino will fall, but we have to be cautious. As I said, for now, unless it's a major event like an airstrike and whatever with casualties, we can at least count on this trading range for now. So I would say for your positions, try and protect 4500 or 4530, which is a strong resistance on this time frame right here, and on the downside 4300 and maybe lower. Okay, that is it for now. There will be more updates as usual on the Slack group. Twice a day I publish an outlook with updated data, so this is the way to go if you want to trade non-directional but with good knowledge or good perspective where the market could go. Thank you for watching and see you on Slack. Bye for now.